Hey everybody, Mike DeSepoli, Heritage Financial Advisory Group. Welcome to the Heritage Market Update for Friday, October 7th, 2022. Hope you're all having a great week. We held the update back until Friday this week because we knew we were going to have the updated jobs report from the month of September. Wanted to get a look at that, see how the market reacted to it, and that's the data that we just got across the tape. So the unemployment rate, fell to 3.5% in September as payrolls rose more than expected by 263,000 jobs. So this is the smallest payroll increase we've seen since April of 2021. However, it is an increase nonetheless. Now, this probably sounds like good news. Jobs for Americans are certainly good news, but in the scope of the Federal Reserve and monetary policy, it's probably not great news, right? Because the Fed, while we continue to believe that fiscal tightening has been overdone at this point, they're not going to back off their position from hiking rates until the labor market cracks, right? And I know that sounds like a terrible thing, that Americans having jobs is a bad thing to the Fed. But again, they use lagging data, they're using lagging inflationary indicators, and it's their belief that inflation won't crack until the job market cracks. We would disagree with that, but these are PhD economists that cannot be told that they're ever wrong about anything. So again, good jobs report. We like to see growth, but the market, as you would expect, futures are down. Market looking to be down about 1% to 1.5% on the open. This coming on the back of the biggest three-day rally that we've seen since December of last year, right? So the schizophrenic market continues, extremely volatile, up 2% one day, down 2% the next, a nice 7% rally over 3 days, and now we'll see how much of it we'll give back here today. Still maintain our belief that the Federal Reserve is making a policy error. They did the necessary heavy lifting to raise interest rates, to tighten monetary policy, and now the tightening is taking effect, and we're starting to see that show up in the real economy. And I think what we need to look at is a couple things. Is first of all, the path that this Federal Reserve is on. Okay, the Fed is hiking rates faster than even in 1994, which was one of the fastest rate hiking cycles on record. Now, for perspective, if you remember the rate hiking cycle of 94, and what came next was the market really went on a nice boom, multi-year boom from, let's call it late 94, early 95, really all the way up until 99, right? So rate hiking cycles don't have to mean death for the stock market. It's just in the current environment we're in, people don't trust the Fed that they won't make a mistake. So what we're looking at here is 2022 is the red line. This is the hiking cycle we're on now. You could see how gradual previous rate hiking cycles were. They took place over a number of years and ultimately took a much more gradual pace higher. So this is where we're at. The dotted line is where the Fed thinks they're going to go. And again, as you can see, this Fed believes that they're going to get rates above 4% and hold them there. And for that, I have two words, which are good luck. I don't think that will be the case, but again, we will allow monetary policy the time to work its way through the system. Now, when we look at inflation, right, we know what the root cause of inflation is. We printed too much money. If you expand the money supply, you get inflation. It has nothing to do with 0% interest rates, right? Remember, we had 0% interest rates for 9 years, and the Fed couldn't even get inflation to get up off the ground. So rates are not the problem, it's liquidity in the system. And obviously, as you would expect, money supply and CPI follow each other, CPI being the inflationary readout. So the blue line on this chart is our money supply, right? We went into COVID, relatively neutral on money supply, and we printed a ton of money. Stimulus, PPP loans, emergency, business, lines of credit, all those forgivable things that the government did, which we would agree was very necessary, but it comes with some side effects. So money supply went way up, and what do you know? Inflation went way up. Well, now look at the money supply, folks. We are returning back to pre-pandemic levels. The money supply leads CPI, and we see that through almost a decade of history here and beyond. So you can take your best guess on where you think inflation is going to go as the money supply is in stark retreat. When we look at the energy complex in Europe, right, that was one of the major things driving inflation. We saw this explosion of energy prices, right, going parabolic. Well, they have also started to come back down. So when we look through the economy, folks, there is plenty, it's not anecdotal, there is plenty of evidence that inflation is in serious retreat right now, and we believe that will make its way into the CPI. But this all but guarantees, this strong jobs report all but guarantees the Fed is hiking rates in October, which was already widely expected, and one more likely this year, I think in December, because there's no press conference for November. So they don't like to hike rates at a meeting with no press conference. Bond market is still on watch, right? We had that initial surge in the 10-year yield up to 4%, and then it basically ran into a brick wall and pulled back pretty swiftly. So we're making another run up here. Now for equity investors, right, we want to see bond yields go down, and we want to see, obviously that would take pressure off of the Fed, take pressure off of interest rates, and it would send equities higher. So reacting as you would expect on a strong jobs report, Treasury's up today, but we'll see if it can, stall out again at that 4% level, or is it something, where it's got some momentum and staying power. Taking a look at the market, nothing's changed, folks. The roadmap is still the same. The objective for the low of this market is still the same. That is this area right here, between 32 and 3,400. I know it's a wide range, but markets are not pinpoint precise. At this level, this would be load the boat territory, folks. You don't get many opportunities like this. And I know in hindsight, we say, well, there's always these opportunities every couple of years, right? This was another opportunity like that, but people were too scared to buy it, okay? We are prepared. We will not be too scared to step in when the time is right, but we don't want to catch a falling knife, right? So is it a guarantee the market goes here? No. It could turn here. We could go slightly lower. We could go below this, but we believe in this range. If you're a buyer of this market, you're getting a good value on stocks. You're getting a good discount on their future cash flow. So in the short term, we've seen a nice little rally this week, right? A lot of volatility, chop, 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 a little bump. Now we'll see where we go from here. Markets basically hovering just above those June lows and those, we call it late September lows. So a lot of market technicians watching this level here based on, the repeating pattern that we see where markets have rallied, failed, rallied, failed, rallied, failed, rallied, and probably failed, right? So again, no drastic action to be taken. This was the goal, the destination, right? Not that we wanted the S&P to go to 3,300, but always had this in mind. So this is a level you want to keep an eye out for. This would bring us down to recessionary levels of earnings, even though corporate America right now is in the midst of the 9th most profitable quarter in the history of America, right? So stock prices are not behaving the way the companies themselves are. That's a dislocation. It will not last forever, and we will seek to take advantage. So in summary, strong jobs report today, but we're kind of in this environment now. We're good data, good economic data, keeps the Fed on the job longer. So not that we're rooting for bad data, but just something to keep in mind. If you see the market's down today, but the jobs are up, that doesn't really square. That's the narrative that's really developing here, is that the Fed's going to keep at it for 1 to 2 more rate hikes. Any questions, reach out to us. Always here to talk to you about the things that matter with your money. Hope you have a great day and a great weekend, and we'll see you back next week for the next Heritage Market Update. Take care.